Welcome to the June 2021 edition of the Zacks Quarterly Market Strategy Conference Call. It's a service of Zacks Professional Services Division, and for first-time attendees, it's a live presentation featuring Zacks strategists providing their analysis of the latest issues and trends affecting not only investors, but the market and the economy, both globally and here in the United States. Joining us once again are Zacks Chief Equity Strategist and Economist John Blank. John's going to give us a lot to think about today regarding the economy after COVID, fitting consumer price inflation into the macroeconomic picture, and the importance of understanding wage push inflation, something you don't hear a lot about yet, and how it impacts the economy. And Zacks Research Director Sheraz Mian is going to talk about the impact of that wage push inflation on future earnings. He's also going to give us a Q2 earnings season preview, talk about sectors enjoying the strongest revisions momentum, and present the earnings picture for the second half of 2021 and beyond. If you have any questions for either of our panelists, feel free to type them into the message field at the right of your screen. We'll get to as many as we have time for. John, we're going to start with you. You have a lot of information. While the economy after COVID is important, equally important seems to be putting all the talk over that I word into proper perspective. It seems a little bit more complicated than it sounds.
Yeah, Terry, thanks. That's exactly it, guys. I want to get my macroeconomics hat on for all of you and help through some of the subtleties, because we're getting through a media picture, through the CPI reports and through the unemployment claims reports, and through the growth upgrades of a lot of errors in thinking. And from an investor perspective, we can gain a lot by understanding what is not worth listening to and what really big things are worth paying attention to in this environment. And macroeconomics, as I understand it at least, is worth looking at. Mark, let's go to the next slide. All right, first of all, let's just start off with this being an equity strategy call. Let's talk about where the S&P is likely to finish at the end of this year. This is 2021 I'm talking about, 6 months from now. So the bulk of the market, as you can see, 75% of this market is looking at this S&P 500 to be above 4,200, basically more of a bull case than a bear case right now. So the market, generally speaking, is still bullish. However, the weight of it is on the market being where it's at, which is we're at 4,250 right now. And that's basically where the consensus is. So the idea the market has right now for you is that there's just a little bit more room to run on the upside, but the bulk of the run in the market probably already happened for 2021. So this is kind of the framework of the market. It's a modestly bullish 6-month look ahead. Let's go to the next slide. All right, so first off, I want to start off with where we are with the after COVID economy. And we'll just go through the broad picture of where the economy actually is, because this is going to get us to the inflation story and give us the background that we need. So let's go to the next slide. All right, first of all, picture of COVID deaths. Amazing to realize that in February we had a massive death rate, well above 3,000 a day. We're well below 500 now and heading to zero, just like Israel. Israel is the leader of the vaccination drive. The United States and Canada, UK, all doing extremely well. And without those vaccinations, there's no question this chart would be very different. So this is all about vaccinations, and it's been very successful. Let's go to the next slide. All right, outside the United States, totally different picture. Do not apprehend the COVID story if you're speaking to me or listening to me and domiciling yourself in the United States, that this thing is over by any stretch of the imagination. The Cornwall G7 summit was all about this. Getting the vaccination rates up in the rest of the world is the problem that we're going to hear about, the solution that we're going to hear about for an entire year. So this is nowhere near over outside the United States. It probably is over in the United States. And that keeps the bullish case on the United States, as we already talked about, because the United States got this vaccination drive together, largely successful. Let's go to the next slide. All right, so mobility. Obviously, when you vaccinate people, you get mobility to turn up, and this is New York and LA. The red line is the subway participation. The blue is the dark blue is driving your car, and the light blue is walking. So New York, interestingly enough, has more drivers than LA now. And walkers in both cities are well above pandemic levels. So first thing to note about this is walking and driving have exceeded pre-pandemic levels. So people are really mobile. They are really getting out. They're getting out way more than they used to. But the one thing they're not doing is taking buses and subways. Now, why are they not doing that? Well, obviously the answer is they don't want to be in enclosed carriages and potentially get COVID. So whether that's a relevant fear or not, it's a fear. And it shows you that the fear of COVID is not actually gone. People are staying away from enclosed things. So I would expect this means that we're going to continue to see outdoor dining established way into next year, if not permanently changing landscapes across the country, because any mayor, any governor is not going to let their restaurants go under for lack of tearing up all of that stuff you see in the streets. So first thing to note is this is telling you right away that two things can happen in a post-COVID environment. One is people can be frenetic. They can be more frenetic than they used to be because they've been cooped up, and they can also still be fearful. So let's go to the next slide. All right, air travel. 2.3 to 2.8 million is where we used to be. We're at 1.8 million now. So we're still 20% off the highs of 2019 in this space. What's that? That's what we're talking about. International travel still not happening. Most business travel is not happening. And by the way, those are both very profitable segments for the airline business. So that's going to hold the airline profitability down for a little bit longer. And a little bit longer could be at least a year. Let's go to the next slide. All right, now the all-important subject of today's call. We've heard a lot about inflation in the April CPI and the May CPI. And there has been a lot of worry about this. And then on the opposite side of this equation, we've had the 10-year Treasury rate plunge back to 1.5%. So this whole CPI story, an inflation story, is very confusing to people, and rightly so. It's an unusual thing to do to exit a COVID pandemic with suppression of so much activity coming out of it. And so the first thing we need to address is where the real issue is, which is wage push inflation. Now, as an economist, I can tell you wage push inflation, the basic idea here is you get labor markets so tight that the overall earnings of everybody, not just those that go from unemployment to employment, but the currently employed, the entire spectrum of the wage and income dynamics of the United States shifts permanently into an excessive overdrive. So what I mean by saying wage push inflation is actually kind of tied to a historical context, which is the 50s and 60s. When the United States exited World War II, we had a huge industrial base, largely military industrial driven, lots of unionization, and lots of government participation in the markets through the labor unions and through the military spending. So at that point in time, wage push inflation basically happened because labor agreements were so big and the governments were so heavily involved that there was annual upticks in bonuses, hourly earnings, union contracts, etc., that overlapped, and this was a big deal. So from the 80s through to 2020, you see very little potential for wage push inflation. The last time any wage push inflation probably happened was in the early Volcker years, when we saw some of that previous economy get lit up by the energy crisis, and then that resetting labor agreements, and then Volcker came in and crushed it. But since then, it hasn't. So one of the mislabeled elements of wage push inflation, people say, well, it's not in the empirical data. But You'll read this a lot in macroeconomics. We haven't seen it in a long time. Those papers have been written from 88 to 2020. If you do look at that data, it is true that we have not seen it. But this gets to the bigger issue of what's happening now, which is if we're going to see wage push inflation, it's going to be government driven. It's got to be big. It's got to be driven by the government. And that doesn't necessarily mean the Fed. It actually means the government. So that's the first key I want to point out here. Wage push inflation is going to require the government to get involved. And so the first thing you're seeing here is that, yes, the labor markets are in a monthly slog. Goldman Sachs have been putting out, the Fed's been putting out 800,000 million jobs a month. And there's your numbers, folks. It's averaging about 500,000, half of that. So it's a slog. And you got at least 10 million jobs to get back to that pre-COVID path, not the pre-COVID data, but the pre-COVID path, 10 million. So do the math, 500,000 jobs a month, 10 million jobs, you get 20 months to get to that pre-COVID path. So that's all the way at the end of 2022. And by the way, the Fed just told you that they're not going to raise rates until 2023. And that's consistent with this chart, which is this is what's going to happen. Just draw a line out from that blue, yellow, green, go out 500,000, 20 months, and you're going to get to that pre-COVID path. And there, lo and behold, the Fed will start to raise rates. So this wage push inflation story is really probably, if it's Fed related to rate related, is a year and a half out. So we're not going to get rid of this wage push story for a while. It's not going to be over, and it's not going to be presented in data for some time. So you just kind of know about it and move along with it. So let's go to the next slide. All right, there it is. So that's the moving average, and you can see that just to get back to the level. Now, this is a more conservative chart. This is just saying, where do we get back to those January, February 20 levels? That's July of 22. To get to the trend is the end of 2022. So the other landmark in macroeconomic thinking is somewhere next summer, we reach that previous level. Now, why does that matter in macro terms? Because aggregates, when you reach prior highs in the demand supply structure, you can have different price dynamics, rate dynamics. So there's a second thing that's a little closer to us, which is July 22. Now, the next thing we're going to finally find out about this whole thing is the Fed could taper. Some people think the Fed could announce at the August Jackson Hole conference through the Fed Powell speech there that tapering is on the table to start 2022. That would change things too. So the other even closer in moment in time for the Fed is if they taper starting at earliest January 2022. Let's go to the next slide. All right, so this is a really interesting chart, which is the pre-COVID path and where we need to get to it. And what you can see is from a GDP perspective. Now we're changing to GDP, not employment. We're probably already at that level we already were at right now as we speak. So this is the beginning of why people are talking about inflation, because once you reach levels, like I told you before, then prices can start to be really meaningful. So again, what we've seen so far in CPI terms, as we'll get to later, was actually just year-on-year base effects and some pre-COVID exit stories. We have yet to see what happens here when we exit that 100 level and move above it. And that's where the wage push story will start to supplant the CPI story that we've seen so far. So all this heating, all these 5% CPI numbers, none of this is related to what is called wage push inflation. And we're just beginning, we're at the very beginning of a wage push credibility regime. And this can go on for, like I said, the next year and a half. Let's go to the next slide. All right, so this is the wage push story. The only way to get above the pre-virus pass the rest of this year through a summer boom depends on the American Jobs Plan, which, as I said earlier, to get a wage push inflation, you need the government, not the Fed part of the government, but the actual federal government stimulus to push you over the edge, to encourage the labor unions to encourage the higher minimum wages, to encourage corporations to raise salaries. All of that has to be incorporated. So this chart is basically telling you that. You have to pay attention to what the government does. The more passage of the American Jobs Plan, the more likely it is that the government's in the market changing the dynamics in a regime sense. Because the way you get the story wrong is you think, oh, we're not in a regime change. We're not in a paradigm shift. And that it could be true. I don't necessarily disagree that we aren't in a big regime change and we aren't in a paradigm shift, but you need to keep a low probability, but not small probability, that we really have entered a regime shift and we really do have a paradigm change underway. And this really might look like a multi-year period where wage push inflation needs to be taken seriously. It's all dependent on what the government does and how long it does it and how deep it does it. So even though they get the jobs plan through, if it's a watered down version or it's multi-year, market might not care. So it's all in the details. It's all in thinking through how sustainable a paradigm shift is underway. That's the real issue for you when you're thinking about inflation. Let's go to the next slide. All right. Other thing to think about, getting a lot of worries about JOLTS numbers, people looking for workers not working yet, staying home, fearful, cutting unemployment benefits. All of that, folks, is related to 2% of the workforce. Between 3.5% and 5.5%, or 4% and 6%, however you want to look at it, basically 2% of the workforce is available to work, wanting to work, and people are looking for them. Those folks will not drive wage push inflation. That is a misnomer. Wage push inflation comes from the rest of us and the government interacting with us. So what this chart tells you is 2008, the recession really was bad. It really got to all of us who had jobs. This time, we all skated through this thing. You kept your job through the COVID pandemic, as this shows, 3% annual growth in earnings. This is not your stock market. This is your earnings. You did fine. So people on this call, me, Sheraz, Terry, all of us, we are where wage push inflation comes from, not the unemployed. It is if we can get annual increases to get up above that 3% level to that 5-6% level. That's what gets wage push inflation. So look at this and say, when did that happen? Well, before the tech bubble, we did get up there. So this is the kind of chart you need to pay more attention to, a wage push story, than the unemployment story. Let's go to the next slide. All right, so here's a fascinating chart about these unemployed people. So as you can see, wages and salaries in the aggregate are back to where they were pre-pandemic. That's the GDP number, right? Incomes go to demand, spending, incomes, all that stuff. So that's already back, but what's not back is the jobs. And the jobs that are not back are the really low-paying ones. So we exited a lot of low-paying jobs. People got out of them because they were front-facing, they were pandemic-related, and the shutdowns hit them hardest. So the jobs didn't come back, but people could, during those times, if they found their way through training or connections or whatever, getting into higher paying jobs, they're simply gone, or they're staying home with their kids, or they retired. So what you're seeing here is, where the focus has been on inflation. I'm just here to tell you that this is kind of an erroneous place to look, because we're talking about the very low wage people. And even if you raise their wages, to get wage push inflation, it has to hit all of us, not just these lower end people. So this has nothing to do with the $15 an hour. Even if it happens, it won't cause wage push inflation. Even if we start to crank up jobs down here, it's not going to create wage push inflation, because wage push inflation is all the other 98% of us. So this is another erroneous thing. We're going to get a lot more of this type of stuff on TV. People are going to talk about it a lot more, and it's relevant, but it's not relevant to inflation. Let's go to the next one. There it is. So this one, how much airtime has come on the TV and the radio and the print media about job openings? This JOLTS thing was never discussed until the last few months. You can see why it didn't matter. The red line is hiring rates, which are pretty much on trend over multi-years. openings are just through the roof. So what's happened here is people are just simply not looking for work, and those who want to hire workers, particularly these low-end jobs, are putting up on Indeed, on Monster, various job boards looking for people. They're not finding them. So this is causing the concern about wage push inflation, but it's really about this mismatch between here you got 8 million people looking for workers, and basically we've got 9 or 10 million people looking for those jobs. So again, 8 or 9 million people in a country of 330 million people is 2.5, 3% of the country. So keep that in mind. Don't mistake the left axis here, which is there are 8 million people, right? 8 million people are the tail wagging the dog, right? I mean, this is not going to cause, unless you get the government to really keep pushing it on its own, it's not going to cause wage push inflation. Let's go to the next slide. All right, this is fascinating. This is your teenagers, 16 to 19, their labor force participation rate. Pre-internet, it was well above 50%. So for decades, half of teenagers worked in part-time jobs. Now, since 2000, we're now down to a third of teenagers working part-time jobs. So kids apparently are staying in school during the summer, so after school programs, summer programs, or simply not interested in working anymore. To the degree that's actual material in this situation. So again, this is kind of structural change. The same is true for women staying home at higher rates. A lot of what you're seeing in that mismatch in the JOLTS is we just don't have these part-time hourly labor force participants at the same level that we used to have. And this is just because of a lot of social factors with raising teenagers and the way parents are thinking about that. That's entirely different than it was 20 years ago. And so this is the other part of the JOLT story, is that we're finally touching on, in meaningful ways, some deeper structural change in the labor market that finally becoming material. But again, this will not cause wage push inflation. We still need the government to get involved with this whole thing. So let's go to the next slide. All right, so consumer inflation, how does this work out? All right, this is the story of the last 2 months, and I can get through this much more quickly than the wage push story. So let's go to the next slide. All right, so inflation is the number one concern out there. And this is what's misplaced. We're talking about all of the CPI data, which did not stimulate the 10-year, and we're not talking about this wage push story, which is much deeper, much more pervasive. So there's kind of a mismatch in my mind about what people are worried about. They're simply not worried about what they should be worried about. And the rest of this is, taper, asset bubbles, obviously makes a lot of sense to me. Next one. All right, so this is the key point. This is really what's happening with the CPI ex food and energy, which is, by the way, the only thing that matters to the Fed, which is the only thing that should matter to you because the Fed cares, which is that green line at the bottom. And as you can see, the target path for the Fed, if you start this green line all the way back in 2018, we're a long ways from where they would get concerned. So yeah, we're ramping up towards that trend, but we are nowhere near getting to that trend. So all you're seeing in the last two things is kind of a catch up in the data running on year terms as we cycle up and out of COVID. But again, we're a long ways from really having the CPI matter in the sense of, what we're hearing on a monthly basis. Let's go to the next slide. All right, so if we do get inflation, where should you go? Really an interesting discussion for this group. Couple things that get interesting. Tangible assets get interesting. Real estate, commodities do better with inflation now because they're priced and the prices rise. So tangible assets do better. For those of us who are in stocks, which is what this call is about, stocks do fine. So one of the curious things about the situation period was this worry about inflation, even if we have it, will probably be okay for stocks, right? Where it won't be good is going to be outside of these two areas. But in general, for this call, there are places to hide out, and it's not going to be that serious for investors unless it gets out of control and we exit into a real high inflationary environment, which I doubt seriously would happen. But that's the main point here is I'm not sure it's clear from history that we should be that concerned as investors. Let's go to the next slide. All right, so the risk market, I'm just going to wrap up before I hand up to Sheraz where we're at in the stock market versus what I just told you. And we'll just kind of create the impression that the market, like we started with, is kind of in a consolidation phase, and that's where we're at for now. Let's go to the next slide. All right, so we just came through 6 months where the long-term governments, the TIPS, the emerging markets, and the investment grade bonds got beaten up because people were rotating into riskier stuff. And now that period's over. So let's go to the next slide. What we're looking at here is a much clearer picture, even though it's kind of confusing to look at, of what is going on in the market in terms of different parts of the market. So the number one thing is S&P 500 is that light blue line at the top. We're up about 8% on the year. The purple line is gold, which rolled over and is heading down. The iShares Russell is, for the most part, going flat, although you see an upward trend, but yet the small caps, for all their outperformance, are still not doing as well as the standard S&P 500. And then you see where the basket cases are. There's next generation SPACs, the Coinbase Bitcoin blow up, and the RKK funds. So what this is telling you, there's been no bid on non-profitable tech stocks and super aggressive things. This makes sense for a consolidation period, that people are basically beyond this whole thing, and staying with core stocks is the way to go. So that's all you can get out of this chart. Let's go to the next slide. All right, there it is. Bitcoin was long ago a worry in the institutional space, and this played out exactly for them. They stayed out of this stuff, and they were right. Let's go to the next slide. Next slide, please. All right, so what's likely to be in a bubble? Again, beyond crypto, which we've already talked about, the electric vehicles is probably the other area. That's Tesla, NIO, all these Lordstown Motors. A lot of things are problematic here. I would think the F-150 and Ford is bullish, and I would look to much more traditional automakers for the electric vehicle play. And I think this is what's alluding to is the non-traditional players are probably not where you want to be right now. Let's go to the next slide. All right, that is a good slide to think about, which is, did margin trading, debt, and Bitcoin's collapse play out in any meaningful way? And as you can see, it didn't. Bitcoin and stock margin trade, speculative activity, aren't really related to one another. It did go down, Bitcoin did go down, and the margin debt didn't go down, because margin debt is basically tied to the level of the market, and as long as it goes up, margin debt goes up. So point here is people were worried about Bitcoin pulling the stock market down. I was worried about it. It didn't happen, and that's something to keep in mind. Bitcoin is probably not going to hit the stock market. Let's go to the next slide. All right, IPOs, unbelievable amount of issuance. Again, probably because the market's really high, people are bullish. Tough to think that this is a negative for the market, but it is excessive. And I would be very cautionary about looking into investing in actual IPOs unless it was a really strong product with a really strong value proposition, and I had a really good understanding of that business. There's just a lot of junk in this number at this point in time. That's where you need to be concerned with. This is clearly frothy, and there's going to be a lot of stuff in there that people just threw out there that's not worth investing in. Let's go to the next slide. All right, so there it is. The market cap of the big mega caps and the central bank liquidity. These are the two key parts of the bull market. And looking at this chart, just keep it simple. Look to that big red circle and realize they're not going sideways even. They're going up. And this is sort of the base of the bull case. The big cap stocks are going to stay in play, and the central banks are not going to keep doing anything but printing money, at least for the next year, year and a half. So again, I'm with the market, modestly bullish, because I just don't see this rolling over. And this is really, really, really the key. I mean, behind the wage push story, behind the consumer price inflation story, the end of the day, it's the central bank liquidity that's driving this market, and it's not rolling over. So keep bullish. And that's really what I'm saying. Next one. All right, there it is. You can see just how dominant those 5 stocks are. 22% of the S&P 500 versus 5% 10 years ago. A big litigation risk for these people. But litigation takes years to play out. Nowhere near going to be an event for these companies for the next 3 or 4 years. There's certainly going to be a lot of headline risk, but generally speaking, this is a feature of stability for the market, and I do think for the next couple of years it will, regardless of that litigation. But keep in mind, it really is not the same market it was 10 years ago, and these 5 companies are a big part of the reason it is. Let's go to the next slide. All right, there is a fascinating story here. This is Amazon versus everybody else in retail, e-commerce retail. So they're over half, way over half of retail regrowers. But if you're looking for other players that are going to do well in this environment, take a look at those names on the left-hand side. Those are good stock market names for outperformance in retail spending, which, by the way, is doing quite well in this environment. Keep those names in mind. A lot of names probably surprising to you: Kroger, Apple, Wayfair, names you probably, Macy's. I mean, these are interesting groups to think about. I'll just throw that out there. Let's go to the next slide. All right, so this is the NASDAQ. We're talking on a day where the NASDAQ's up, everything else isn't. And what you can see here is back in the first quarter of 21, it rolled over first. But it keeps on rolling over and moving up when it hits that red line, which is support, and moving higher, which is what it's doing now. So at the end of the day, whenever you look at the Russell, the S&P 500, the NASDAQ, when you look at these technical support lines, they haven't been broken, and we're still in the bull market. So unless this line gets broken, there's no real reason to get bearish. It gives you an idea that really you got to get the NASDAQ 100 below 12,700 to really get people worried. And that's a long ways from where we are right now. Let's go to the next slide. All right, so the bullish factors is chip stocks within the NASDAQ. This is pricing that is going to continue to be strong. Doesn't really get put into the CPI, not a wage push inflation story. This is just simply the world we're moving into and how important these chips are. It's also kind of an electric vehicle story, because electric vehicles are basically electronic vehicles. And the more we get pushes for all these electric cars, the more that it doubles down on this problem. So tough to not be bullish chips given a picture like this until someone gives a lot more insight into how this rolls over and when it does. But it hasn't happened yet, and I don't expect it will for the next year. Let's go to the next slide. All right, so delivery times in the material space are now at levels we haven't seen in 30 years. So this gets to my first point, which is, are we in a regime or paradigm shift? I think this is, again, probably transitory, probably related to COVID and the Suez Canal and other issues with delivery and the shift towards goods, and it's probably going to work itself out. However, it might be stickier than people think. And this gets to this idea that we do have to kind of think about whether we really look back on the COVID pandemic 10 years from now as a regime shift that really did change things. And again, I think it's a low probability thing, but low probability things happen, and we just got to pay attention to things like this. Let's go to the next slide. All right, so this is my last slide before I hand out to Sheraz. And what I want to point out here is you can see that kind of out of place line as the pandemic. And this is potential output, which is the black line that's drawn, versus the factors of production labeled capital and productivity, which is typically called multi-factor productivity. But if you do growth modeling, you get these 3 factors: growth of labor, growth of capital, growth of productivity. So what you can see here is during the pandemic, the big driver was productivity. And if you look out to 2029 in macroeconomic modeling, the big driver First is some labor force improvement for a year or two, which is the length of the wage push story, and then it turns into a productivity gain story. So, unless this chart changes a lot, this wage push inflation worry is going to be with us for probably 2 years until it gets pushed aside by the Fed's rate hikes and we exit this period of worry about inflation because the Fed's back in the game. So the basic point is we've got a point where the Fed will not get in the game until 2023. We've got a government that's moving stimulus payments in, monetizing the system, raising savings, pushing for wages to go up, and creating the potential for wage push inflation to some degree, which it wants, but the Fed is out there 2 years from now and putting an end to it one way or the other. So the window is pretty small for this wage push inflation to get rooted, but it's definitely a risk for the next 2 years. And that's really what I'm going to finish off with and let Sheraz take over and tell you a little bit about earnings.
So, Shiraz, we're going to bring you in here now. John ends on a note that I think might be particularly important regarding earnings. Is wage push inflation going to have an impact on future corporate earnings? And if so, is there any way to tell, put a timeline on it, maybe tell when it might manifest itself?
So yes, thanks for the very detailed uh, and topical framework that John left us with as to how to evaluate and read the incoming data uh, over the coming time period. With respect to the time period, Terry, it's a moving target. I would say a year to 2 years, as John alluded to. Will it have an impact? Absolutely. Earnings and earnings growth has two components. One is revenue growth, sales growth, which is correlated to economic growth, GDP growth. And then you have margins, and margins is where the inflation variable has the most direct impact. So, to the extent that the company you're looking at has the ability to pass on the increases in input costs and all the variables that they use in producing their product, then their margins will remain good. So an Apple, a Microsoft, uh, a Tesla, perhaps will be able to push on the price pressures to the end consumer. The producers of more undifferentiated products will struggle with it and will perhaps have inflationary pressures show up in compressed or tightened margins. So that's the transmission mechanism through which all of this will show up in the coming periods. So let's get to my first slide. And what I want listeners to take away from my discussion here is essentially 3 points. One is that regular readers of my earnings commentary already know that the earnings picture is very good, and it hasn't been this good in a very long time. The second point is that the good part about earnings, the strong part, isn't solely because of these very high growth rates. Like on this chart, you could see that 2021 earnings are on track to be up almost 35%. It's not the growth rate, uh, which though is very noticeable, uh, but it's the improvement in the outlook, meaning earnings estimate revisions, which regular listeners know is at the core of how we look at uh, earnings strength and outlook for stocks. So in this slide, it's pretty self-explanatory. You could see we're coming off of a pretty heavy hit to earnings, and it's pretty impressive, and it continues. Now, another takeaway from this slide is that this outsized growth that we are seeing here isn't solely a function of easy comparison. So if we go to the next slide, you will see what I'm talking about. Um, and here, what we are showing is the aggregate total for the S&P 500. So the dark greens are the actual earnings, and the shaded ones are estimates. So it's 1.65 trillion or 1,653 billion is the current estimate for S&P 500 earnings in this year. And you could look back and see that it's notably above where we were in 2018 and 19, which itself was a huge bump. In 2018, we essentially had a big drop down to the bottom lines as a result of the corporate tax cut. And that's why from 2017 to 2018, we had that huge bump. Companies were able to sustain that level of profitability in 2019. And when we were at the beginning of 2020, the expectation was for a high single digit growth in 2020. Then obviously the pandemic hit, and we can see what happened. But what's happening in 2021 is that we are not only recovering what we lost last year, but then some. And we will build on that next year as well. So let's go to the next slide. And you could see here the improving outlook. This is basically showing the aggregate earnings total for 2021 over time. And you could see from last summer, we have come a long way. So I mentioned the growth rates are very high. I mentioned that qualitatively, the earnings picture is very good. And the third element is this trend in estimate revisions. And you could see here that the trend has been extremely positive and extremely strong. And the key thing you have to be mindful of and keeping an eye on is not so much what the growth rates in the preceding quarters are, or what the growth rates for the current period currently expected are, but rather how those growth rates continue to evolve. Are they improving? Are they going up? And the magnitude of that improvement. So let's go to the next slide. So this is the same uh, metric. We are again looking at 2021 earnings. This has been backed out of current market expectations using a market cap over total aggregate earnings estimate as a PE, and then backing out what current market, given our estimates, show as the index EPS. This is slightly different than the what the Standard and Poor's model is, but it gives you a good idea nevertheless. And you see the same trend here. The 183.58 is the index expected EPS for 2021. Let's go to the next slide. So where are the revisions, and which sectors are enjoying the biggest gains? And as you could see here, it's very broad based. 13 of the 16 sectors have had their estimates go up since the start of the year, and the biggest beneficiaries are the ones that you would expect in a cyclical upturn. So energy, uh, estimates have more than doubled since the start of the year. Materials, more than 44%. Construction, finance, technology, industrial products, even retail. And for retail, just keep in mind Our retail is slightly different than the official GICs. We have the Amazons and the other e-commerce companies in our retail sector. Now, the sectors that have had estimates cut since the beginning of the year are also the usual suspects: consumer discretionary, transportation, aerospace. But if you look at the index level in the aggregate, since finance and technology are such huge chunks and such huge earnings contributors relative to all the other 14 sectors combined, the bulk of the growth in the aggregate in estimates since the start of the year have come from technology and finance, and then with energy accounting for a big part of the rest. Let's go to the next slide. And just to give you a little more color on where the almost 35% growth is coming from, as we showed you already, it isn't all easy comps. Easy comps are driving the outsized comparisons, but that isn't the sole reason. And you could see here that 6 sectors are the only ones that are making less than the pre-COVID levels. Most of the others, the big ones, particularly technology, medical, retail, construction, autos, they are the real growth drivers, and they are making are on track to make more than pre-COVID levels. I have shown spotlighted the tech sector, the biggest earnings contributor, and you could see that they had positive earnings during COVID, 5.6% earnings growth. Let's go to the next slide. So coming to the Q2 earnings season, the trend has been broad-based positive revisions across all major sectors, something we saw in the context of the preceding quarter as well. In fact, this has been a trend that we have been flagging steadily since last summer. The expectation is for roughly 60.5% earnings growth and almost 18% top line growth. Easy comparisons are a big reason for that 60.5% earnings growth. But even if we compare the expected Q2 earnings tally to the pre-COVID Q2 2019, it's still almost 9% above that level. So it's not entirely easy comparisons. And as I mentioned earlier, the key factor in the strong earnings narrative will be how the revisions trend evolves as the Q2 earnings season unfolds, and as we hear from management teams about how they see the outlook in their businesses evolving. Let's go to the next slide. And this is the big picture view. You could see here the very strong growth for the June quarter. It's still pretty impressive in the second half of the year, 21.6% in Q3, 17.1% in the last quarter of the year. And the key variable to keep in mind will be how those growth rates evolve. And if the revisions trend remains as strong as we have seen over the last 3 to 4 quarters, then you should be perfectly justified in having a bullish and positive outlook, specifically on the earnings front, and that obviously has implications for how you see the market as a whole. That is the big picture view I have. A regular readers know my commentary on ZRS and ZAT. I try to stay away from the nitty-gritty details of the numbers and discuss more of the big picture. So with that, I'll pass it on to Terry.
Thanks, Shiraz. Just one more thing I wanted to bring up and get your reaction to. The term ESG, or environmental, social, and governance, is cropping up a lot more lately in conversation and in print. Are companies going to be citing ESG factors more in their reporting for Q2 and beyond?
I think this has become a key element. John mentioned some regulatory risks to the big tech companies. The ESG issue is more of a smokestacks and the traditional material space. So the direct implication is in the energy space, and we have been hearing and reading how there's a lot more shareholder activism in the boardrooms and elsewhere with respect to companies. So yes, I envision this being a recurring theme. We have been hearing about this in previous calls, and I believe this will remain a continuing issue with management teams and with boards as to how well they are doing with respect to the environment and all the other issues that's important to consumers and their employees and their shareholders.
All right. Well, time always flies when you're having fun. And to that end, that's it for another of our calls. Thanks to our panelists, John Blank and Sheraz Mian. Hope you found their presentations informative. If you would like copies of John's or Sheraz PowerPoint presentations that were featured in today's call, just email zrs@zacks.com, and they'll find a way to get them to you. You can also contact your ZRS representative directly or access them in the GoToWebinar console after the webinar is over. If you have any questions regarding our services, feel free to, again, email them to zrs@zacks.com. In the meantime, hopefully everyone is doing well during this time. Still some uncertainty out there. Everyone here at Zacks is doing what we can to service each of you as we are still mostly working remotely. So we appreciate your understanding for that. Thank you for joining us. Feedback always welcome. In fact, after you close out the webinar, you'll be prompted to fill out a short survey. We'd appreciate it if you would do that, because we use those comments to improve the quality and the content for future calls. And as always, we will look forward to the next time we're all together on the call.